Hello, welcome to Gurulkan Çakır's YouTube channel. Today we are going to talk about value-added tax in Turkey. Value-added tax or VAT is an indirect consumption tax that is levied on both the supply and the importation of goods and services. From the producer to the end user, it is a tax that is triggered at each phase. The legal taxpayer of the VAT is the supplier or the importer of the goods and services. In principle, the suppliers and the importers have to register themselves for VAT in the local tax offices. Both the supplier and the importer are normally able to set off the VAT incurred on their business expenses against the VAT they collect from their customers. As a natural result, the final consumers who are unable to set off the VAT on the goods and services they purchase ultimately have to bear the economic burden. Delivery of goods and services within the context of commercial, industrial, agricultural or independent professional activities, as well as importing goods and services into Turkey trigger VAT. Any person or legal entity engaging in taxable transactions within Turkey must register as a VAT taxpayer in the local tax office. When a commercial entity is established and registered in the local tax office for corporate and income tax purposes, the VAT registration is also automatically made. In circumstances where the supplier of services does not have a permanent residence or establishment in Turkey, the other party to the taxable transaction is held responsible for the payment of the VAT. The reverse charge is a simplification measure in order to avoid the need for service suppliers to register in Turkey. The VAT paid to the tax office by the Turkish customer on behalf of the foreign supplier is treated as input VAT and can be set off in the same amount. The reverse charge applies to the services only. As for the goods imported into Turkey, the importer is liable to pay the VAT at the customs. There are two types of exemptions in Turkish VAT regulations: partial exemptions and full exemptions. In a partial exemption scenario, the input VAT that is paid by the purchaser of the goods or services can neither be deducted from the output VAT nor refunded. In a full exemption scenario, as the input VAT paid on invoices can be fully deducted, the pricing of the taxpayer will only include the purchase price plus the profit, meaning there will be no VAT burden on it. When the input VAT of a business is higher than its output VAT, the difference can be recovered. However, unless specific exemptions apply, the difference cannot be refunded but carried forward in order to set it off against output VAT to be incurred in the future. When the input VAT of a business is higher than its output VAT, the difference between the input and output VATs cannot be refunded but carried forward in order to set it off against future output VAT. However, there are exceptions where such excess or the whole input VAT in the absence of transactions subject to VAT can be refunded to the taxpayer. Tax returns for VAT must be filed with the local tax office monthly. No annual VAT returns are submitted. The tax returns are submitted through an electronic system.